Welcome to Wealth and Means, advice dressed up like hard work.
Good day to our members from Canada, Hong Kong, India, Lesotho, Lithuania, Pakistan, and the United States. It's episode 44. Let's get into it.
This week, the world kept telling us the same thing in 12 different accents, and almost nobody said it out loud. Copper piled into American ports at a record pace, not because anyone needs it yet, but because a decision hasn't been made. Washington put a floor price on a chemical most people can't pronounce. 18 out of 18 rare earth elements went up in a single month. And the American labor market lost jobs while the unemployment rate went down, which is the kind of sentence that should stop you mid-sip. So we're going to walk through 12 stories that didn't get the front page, and you'll notice they rhyme. Then we'll wake up ready, where the coming week hands us an inflation print, a consumer test, a listing on the New York Stock Exchange, and a central bank in Tokyo that's finally running out of patience. After that, we've got a knowledge bomb, a humor me from me, on why the most sophisticated industry on Earth still names things after zoo animals, and a greater debate about whether AI agents change software or change what software companies are worth, where neither side gets to win. And we'll close with the guy who invented those annoying little tests that make you prove you're not a robot, and then figured out how to make the 10 seconds you waste on them digitize a century of newspapers.
Everything this week is about what you can trade for something else, and the moment you find out you can't.
Let's go.
Each week, we explore ideas that help you pause, reflect, and think more deeply about the opportunities all around you.
It's the perfect mix. A little information, a few stats, some real-world insights, and just enough deep talk to make you feel smarter before your second cup of coffee. A quick thank you to our sponsor, agentweekly.ai, chronicling the absurd, the ambitious, and the algorithmically challenged corners of the AI agent economy. More than 200,000 metric tons of copper landed in American ports in July. That's the biggest monthly inflow on record in shipping data going back to 2014. And here's the strange part. Almost none of it arrived because somebody needed to build something. It arrived because traders are front-running a tariff decision that hasn't been made yet. Copper, for September delivery, touched $6.70 a pound on the COMEX, a fresh all-time high in New York, according to mining.com. Now sit with the mechanics of that for a second, because the record price isn't a demand story at all. It's a logistics story. Metal that would ordinarily be sitting in Rotterdam or Shanghai is now sitting in New Orleans and Baltimore, which means the rest of the world is short of a metal that America currently has too much of, and supply outside the United States keeps deteriorating anyway. It's a shortage manufactured almost entirely out of anticipation. That matters because copper is close to the least substitutable input in the whole electrification build. You can swap aluminum into some transmission lines, you can redesign a motor, but you cannot engineer your way around conductivity. And the second-order problem is uglier than the price. Whenever that tariff call finally lands, somebody is holding a very expensive pile of inventory, and the unwind moves faster than the buildup did. This surfaced now because July's shipping figures just published, and they're an outlier by a wide margin.
That's not a market discovering value. That's a market discovering a deadline.
Which brings us to a related decision that did get made. On Thursday, the administration signed a Section 232 order on polysilicon, the refined silicon that goes into both solar panels and semiconductor wafers. It's not just a tariff. It's a 15% duty on downstream products, plus a set of minimum import prices. And those numbers are oddly specific. $21 a kilogram for polysilicon, $100 a kilogram for ingots and wafers, 22 cents a watt for solar cells, 38 cents a watt for modules. It takes effect December 4th. Here's what makes a price floor different from a tariff, and it's worth understanding. A tariff adds a fixed amount on top of whatever the exporter charges, so an exporter can always eat some of it by cutting their price. A floor says there is no price below this, full stop. If a Chinese producer decided tomorrow to sell polysilicon at zero, the floor would still hold at $21. You've removed the exporter's main weapon. Why it matters is that China holds something close to a near monopoly here, and both the solar industry and the chip industry sit downstream of the same material. The second-order piece is the part nobody's pricing yet. The order also directs Commerce to build an incentive program for domestic production, which means between now and December, we should expect a run of capital spending announcements from companies that have been waiting for exactly this signal. It surfaced this week because the order was signed on August 6th and reported out on the 7th.
When you set a floor, you're not protecting an industry, you're announcing one.
Stay in the same aisle of the periodic table for a moment. Every single one of the 18 rare earth elements tracked in the standard market basket rose in July. Every one. That's the first month in 2026, with zero declines anywhere in the basket. And at the same time, Chinese exports of rare earths to the United States actually fell about 5% month over month to 590 tons, even as Beijing's overall magnet shipments kept recovering after the export curbs were eased earlier this year. Now, a basket where everything rises together is a genuinely different animal from a basket where a few things rise. In a normal month, you get dispersion. Neodymium catches a bid because somebody's building motors. Cerium drifts lower because polishing demand is soft, and the average barely moves. Zero dispersion means the thing moving isn't any particular buyer. It's the supply side, or the perception of it. That matters because rare earth magnets sit inside almost every electric motor built in the last 20 years, from car drivetrains to wind turbines to the little actuator in your phone's camera. And the second order effect is genuinely interesting. Sustained high prices are the only thing that has ever made magnet recycling and ferrite substitution economically real. Cheap rare earths kill the alternatives. Expensive ones fund them. This came into view because July's full basket data closed out with an unusually clean signal.
18 for 18 isn't a price move. That's a message.
That same pattern, where the paperwork matters more than the product, shows up in a story almost nobody covered. On July 24th, the United States imposed new Section 301 tariffs tied to forced labor across 60 trading partners that together account for more than 99% of everything imported into this country. The rate is 10% if a country already has a legal prohibition on forced labor imports on its books, and 12.5% if it doesn't. The in-transit grace period expired on July 28th, which means this was the first full week where every single entry cleared under the new architecture. Published West Coast container rates for August climbed back above $7,000, landing somewhere around $7,200 to $7,300 per box. But the freight rate isn't really the story. The structure is. Read that rate difference again. The tariff isn't priced off the goods, or the factory, or even the industry. It's priced off whether a country has passed a particular law. That's a 2.5-point tax on legislative activity. Why it matters is straightforward. It hits importers immediately, entry by entry, with no averaging. But the second-order consequence is the one to watch, because it gives 60 governments a very clear, very cheap way to cut their own export costs. Pass the statute. Expect legislative movement in Southeast Asia this fall. It landed on the radar this week, because the grace period finally ran out.
They didn't tariff the goods, they tariffed the legal code.
Now to the number that should have been the headline and mostly wasn't. American employers shed 23,000 jobs in July. The consensus was for a gain of 83,000, so that's a swing of more than 100,000 against expectations, driven by 53,000 lost government positions, plus softness in retail and in leisure and hospitality. And the unemployment rate went down. It fell to 4.1% from 4.2%. Here's how both of those things are true at once, and it's the most useful thing you'll learn this week. The payroll number and the unemployment rate come from two different surveys. Payrolls count jobs at businesses. The unemployment rate comes from asking households whether they're working or looking. If enough people stop looking, they leave the denominator entirely, and the rate falls even as employment shrinks. That's what happened. Wage growth backs it up. Average hourly earnings slowed to 3.2% over 12 months, the weakest since May of 2021. Why it matters is that the Fed reads both surveys, and they're pointing opposite directions. The second order piece is the one people keep missing. A shrinking labor force is a supply shock, not a demand shock. Fewer workers doesn't cool prices, it can raise them. This hit on Friday morning, and the market's first reaction was to look for a rate cut that the pricing doesn't actually support.
Fewer people working and fewer people looking is not a soft landing. That's a smaller plane.
Another story gaining momentum, and this one's 100% about the atoms. South Korea's president just wrapped an 11-day trip through the United States and South America and came home with critical minerals memoranda signed with Brazil, Chile, and Argentina. lithium, copper, and the rest of the battery stack. Seoul also started importing 880,000 barrels of Argentine crude on a trial basis this year, which is a small number in oil terms and a large number in signal terms. Think about Korea's actual position. It has essentially no domestic lithium, no domestic copper, and a battery and electronics complex that sits in its top three exports. That's a restaurant with a famous kitchen and no farm. And what a chef does when the ingredient market gets volatile is stop buying at the market and start signing contracts with growers. That's exactly what this trip was. Why it matters is that it takes real volume out of the spot market for a decade at a time. And the second order effect is one that traders quietly hate. When enough of these bilateral deals stack up, price discovery migrates off exchange. The published lithium price becomes a reference for a shrinking share of the actual metal that moves. This surfaced now because the trip concluded and the memoranda were disclosed at the start of the month.
Every one of these deals is a country deciding it would rather have the ingredient than the option to buy it.
Here's a small one with a long shadow. On August 1st, the Shipkila Pass reopened for seasonal border trade between India and China after a 6-year freeze. It sits at around 12,000 feet in Himachal Pradesh, and the goods moving through it are unglamorous. Wool, barley, dried fruit, processed food, in volumes that wouldn't register as a rounding error against the roughly $100 billion bilateral trade relationship these two countries run through ports and air freight. So why does it register at all? Because a Himalayan trading post isn't an economic instrument, it's a thermometer. It closed in 2020 during the border standoff, and it stayed closed through every round of talks since. Reopening it costs Beijing and New Delhi almost nothing in trade terms and signals something in political terms that neither side has to say in a communique. That matters because India and China are the two largest buyers on the other side of nearly every commodity story in this segment: copper, rare earths, crude. And the second order consideration is the practical one. A working overland channel is infrastructure, and infrastructure that exists gets used for larger things later.
Nobody reopens a mountain pass for the barley.
Now for something that shouldn't be happening according to the forecasts. Vietnam's economy grew 8.4% year over year in the second quarter, against a consensus that expected growth to slow. Industrial production ran up 12.7% in June. The Asian Development Bank now has Vietnam as the fastest growing economy in ASEAN this year at around 7.2%. And here's the wrinkle that makes it interesting rather than just impressive. Vietnam's merchandise trade deficit widened in July to about $3.6 billion. Most people read a widening deficit as a weakness signal, and in Vietnam's case, it's very nearly the opposite. The country's model is import components, assemble, export finished goods. So the deficit and the growth aren't in tension. They're the same fact viewed from two different months. You import in July what you ship in September. Why it matters is that Vietnam has spent this decade absorbing manufacturing that left elsewhere, and the numbers say the absorption is still accelerating. But the second-order risk arrived 4 stories ago in this very segment. Vietnam is one of the 60 economies now inside the new forced labor tariff architecture, which means a country whose entire growth engine is assembly for export just got a new per-entry cost on everything it sends here.
Growing 8% into a tariff you didn't design is a very specific kind of exposed.
Let's move from the physical to the speculative, because there's a tell in the tape. All 3 of the quantum computing pure plays snapped back roughly 20% in a single week after a genuinely brutal summer sell-off. D-Wave closed at $21.39 on August 5th. The consensus analyst target sits at 37 and change. IonQ raised full-year guidance to $270 million on revenue growth north of 700%. Now, 700% growth off a small base is a real number that means less than it sounds like, and everybody involved knows that. The detail worth noticing is the gap. The consensus target is roughly 70% above where the stock actually trades, which tells you the analysts didn't cut their numbers when the stock fell. They left the targets and let the price do the moving. That's a specific behavior, and it usually shows up in sectors where the story is long-dated enough that nobody has to be right this year. It matters because these 3 names have quietly become the cleanest read on retail risk appetite in the market. When speculative long-duration stories bounce 20% in a week, that's not a quantum computing data point. It's a liquidity data point. And the second order version of that, it's a leading indicator for the small cap listing window, which we'll come back to in a few minutes.
When the furthest out stories moved first, somebody's balance sheet got easier.
Closer to home and closer to the checkout counter. Buy now, pay later volume in the United States is on track for about $128 billion this year, up roughly 19%, with something like 96 million American users. A Gallup poll from April found that 51% of Americans have used a short-term installment plan for an online purchase, and about 10% say they use one frequently. Here's the number inside that number. The fastest growing category for buy now, pay later isn't furniture or electronics, it's groceries, up about 11% in a single year. And that's the whole story in one word, because this product was designed for the sofa, a discrete, deferrable, largish purchase where splitting it into four made obvious sense. Groceries aren't deferrable and they aren't discrete. They recur every 7 days. Financing them isn't a convenience product. Why it matters is that this is happening while credit card balances actually fell $25 billion in the first quarter, which on its own reads as consumers deleveraging. And the second order piece is the reason that reading is wrong. These balances still aren't consistently reported to the credit bureaus, so a meaningful slice of household leverage simply doesn't appear in the data that everyone uses to measure household leverage.
Debt that doesn't show up in the data still shows up in the kitchen.
Something extraordinary is happening in audio pricing. The average mid-roll podcast advertisement is now clearing about $28.50 per thousand listeners, the highest CPM ever recorded in the industry. Host read spots command roughly a 22% premium over programmatic placements and account for around 55% of all podcast advertising revenue. Global podcast and video podcast ad revenue crossed $5 billion for the first time, up nearly 20% year over year. Now set that against what's happening on the production side. Substack shipped a full recording studio into its product in March. Solo or two-guest recording, screen sharing, custom watermarks, auto-generated thumbnails, plus an auto-clipping system that pushes segments to YouTube without anyone touching an editor. So the cost of making the thing is collapsing at the same moment the price of the least automatable inventory inside it is hitting a record. That's not a contradiction, that's the mechanism. Why it matters is that it clarifies where the value actually sits in creator media. Not in production, not in distribution, but in the 20 seconds where a specific human vouches for something. And the second order implication is a consolidation one. A creator who needed 6 subscription tools 2 years ago now needs about 2, which is a revenue problem for 4 companies.
The machines took the editing. They still can't take the endorsement.
And we'll finish with the strangest asset sale of the year, which is also the cleanest lesson in it. For 4 years, the United States government has been the extremely reluctant owner of a 348-foot superyacht. This week, it finally got rid of it. The Amadeus sold for $187 million against a vessel that had been valued north of $300 million. Call it a $138 million haircut. According to CNBC, the boat was seized back in 2022 from a sanctioned Russian oligarch, sat through a long legal fight, and was finally auctioned by order of the Justice Department. The buyer is Abbas Sajwani, who's 27 years old and the son of the Dubai property developer behind Damac. Now ask why a thing worth $300 million clears at 187, because it isn't depreciation. The boat's fine. It's that the credible buyer pool for a 348-foot yacht is maybe a few dozen human beings on the planet, and the phrase, seized from a sanctioned oligarch by the American Justice Department, quietly deletes most of them. That's what illiquidity actually costs, expressed in a single number. And the second order piece is larger than one boat, because governments are now sitting on an enormous pile of seized property, real estate, aircraft, crypto, art, all of it facing the identical problem. Every forced sale into a thin market prints a comparable, and that comparable marks down everything else in the pile. Now let's wake up ready. Let's start with the thing that sets the tone for everything else. The Federal Reserve has now held rates at 3.5% to 3.75% for 5 consecutive meetings, and the July vote was 9-3. All 3 dissents came from regional presidents, Cleveland, Minneapolis, and Dallas. And here's the detail that makes it unusual. All 3 dissented in the same direction. They want rates higher. That's the first time since September of 2016 that three policymakers broke ranks with a unified view of which way to go. So, the baseline you need in your head before Tuesday: the market's currently pricing roughly a 60% probability of a 25 basis point hike at an upcoming meeting and effectively zero probability of a cut in September. Zero. That's the number most people have backwards.
5 years above target has a way of turning the doves into arithmetic.
Which makes the inflation print early next week the single most consequential data point on the calendar. Core PCE ran from 3% in December to 3.4% in May, and CPI's been printing in the high threes. But don't watch the headline. Watch the gap between headline and core. Brent crude topped $100 a barrel on July 23rd for the first time since May, after opening that month around 72, a 20% move in 31 days. If next week's headline number runs hot and core stays contained, that's an energy pass-through story, and the committee can argue it's transitory for the ninth time. If core is what's accelerating, the three dissenters have their case, and the hike odds that already sit near 60% go materially higher. The second-order consequence lives in duration. A core surprise reprices the front end, which flattens the curve, which hits regional banks and anything financed on short paper long before it touches the long bond.
Headline is weather, core is climate.
Then comes the consumer test, and it's a good one because it stacks retail sales data against retailer earnings inside the same 72 hours. Walmart reports in the same stretch as Cisco on Wednesday and Applied Materials on Thursday. For Applied Materials, the consensus is $3.39 in earnings per share on about $9 billion in revenue. Call it 37% earnings growth and 23% on the top line. Here's what to actually listen for in each. For Cisco, it isn't revenue. They beat on revenue last quarter, and the stock fell anyway because gross margin compressed. Margin is the only line that matters. For Walmart, ignore the comparable sales headline and listen for the general merchandise versus grocery mix. If grocery is carrying the comp, the consumer's trading down, and that connects directly to the installment finance grocery data we just covered. And the second-order move, if that mix skews defensive, small-cap consumer discretionary reprices first because that's where the leverage to domestic discretionary spending actually lives, and it has no pricing power to absorb a tariff.
The comp tells you what they bought. The mix tells you what they gave up.
Capital markets next, and there's a specific name and a specific date. Lundy & Wason is scheduled to list on the New York Stock Exchange around August 12th, targeting a market capitalization in the neighborhood of $1.6 billion. And it comes right on the heels of Braveheart Bio's NASDAQ listing on August 6th at roughly $1.1 billion. Two small-cap listings inside a week is a real signal about one specific thing: the mid-cap underwriting window, which has been effectively shut for most of the year. And the theme here is a barbell. At the other end of the same pipeline, the two largest private technology companies in the world have both submitted confidential draft registrations, one of them targeting an autumn NASDAQ listing, which means the back half of this year's calendar is a handful of billion-dollar deals, and two enormous ones with almost nothing in between. So watch the pricing on Lundy & Wason relative to its range. If it prices at or above and holds the break, expect the September and October small-cap calendar to fill within 2 weeks because bankers have deals sitting on shelves waiting for exactly one clean comparable. If it prices wide and breaks issue, that calendar stays empty. The autumn mega listings get repriced downward on the read-through, and that flows straight into private secondary marks and the venture funds carrying them.
One small listing decides whether 40 other companies get to exist in public.
And keep one eye on Tokyo, because it's the trade nobody's positioned for. The Bank of Japan has signaled it may finally raise borrowing costs in September, worried about persistent price pressure and a weak yen. And it did that while simultaneously cutting the government's real growth projection for fiscal 2026 to 0.9% from 1.3%. Hiking into a growth downgrade isn't something a central bank does casually. The signal to watch is the dollar-yen pair, and the level that matters is whichever handle triggers verbal intervention, because that's the moment policy stops being about inflation and starts being about the currency. What's priced today is a slow, apologetic Japanese normalization that nobody really expects to arrive. The second-order consequence, if it does, the yen carry trade is the cheapest funding leg in global macro. And an unwind doesn't hit Japan. It hits whatever the borrowed yen bought. That's emerging market local debt, high yield credit, and long duration equities in roughly that order. And it happens over days, not quarters.
The yen isn't a currency trade, it's the cost of everyone else's leverage.
Here's my one watch for, and it isn't a headline number. When the household survey data comes around again, go find the labor force participation rate before you look at anything else. Last week, we got an unemployment rate that fell for the wrong reason. It dropped because people stopped looking for work, not because they found it. If that continues, you get a genuinely uncomfortable combination. An unemployment rate that looks healthy, a payroll count that's shrinking, and a labor supply that's contracting into an economy where energy and metals are already pushing prices up. That's not a soft landing, and it isn't a recession. It's a smaller economy that prints a better-looking number. And it's the easiest way for a policymaker to be wrong this quarter. Everything in this episode's been about what you can substitute. You can substitute aluminum for copper at the margin. You can substitute one supplier for another. You can't substitute for a person who left the labor force.
And that is how you wake up ready. Now let's light the fuse on a knowledge bomb. Here's a thing that happened this year and barely registered as strange. Alphabet, one of the most reliably cash-generating companies ever assembled, printed a negative free cash flow quarter, first one since it went public. Amazon's trailing 12-month free cash flow has compressed from around $38 billion down toward roughly nothing, depending on where you draw the window. Meta's operating on margins that would have been unrecognizable 3 years ago. And every financial desk on the street is staring at the same chart to explain it. Combined capital spending across Amazon, Microsoft, Alphabet, Meta, and Oracle is running somewhere between $700 and $725 billion this year, with consensus pointing at $1 trillion a year by 2027. The neoclouds are doing a smaller version of the same thing. CoreWeave's deploying $30 to $35 billion against a $99 billion backlog, funded heavily with high-yield debt, free cash flow deeply negative. The market's reading that as a pit. Money goes in, nothing comes out, repeat forever. I want to argue that's the wrong shape. And to see why, you have to open up what that spending actually is, because it isn't one thing, it's two, and they behave completely differently. Roughly 40% of an AI data center build is the shell: land, concrete, steel, high-voltage transformers, cooling infrastructure, the utility interconnect. Those are long-lived assets. You depreciate them over 15 to 25 years. Once the concrete's poured and the grid tie-ins live, the heavy civil engineering cash outlay for that site drops to roughly zero. It's done. It doesn't come back. The other 60% is the silicon and the fabric. GPUs, custom chips, optical switching, networking racks. Those run on a 3 to 5 year refresh cycle, and honestly, that timeline's been compressing because every architectural jump forces the question again. So today's 700 billion number is drowning in shell. It's the brutal one-time cost of buying land, raising buildings, and locking down power. Now hold on to a very simple identity. Free cash flow is operating cash flow minus capital expenditure. That's it. During a greenfield expansion phase, capital expenditure eats every incremental dollar of operating cash, so free cash flow compresses or goes negative. That's not distress. That's arithmetic. Then run it forward. Say it's 2031 and the physical footprint is built. The $2 to $3 trillion of infrastructure raised between 2024 and 2028 is fully operational, generating cloud and enterprise revenue on multi-year contracts. Operating cash flows compounding off that installed base, and capital spending drops to refresh only, call it $200-300 billion a year, purely swapping aging racks for newer silicon. Cash going out falls off a cliff. Cash coming in keeps climbing. Reported earnings still look heavy because you're carrying enormous non-cash depreciation from the build-out wave, but that's an accounting shadow, not a cash event. What you actually get is companies that generate nothing today turning into cash machines almost overnight. Buybacks, dividends, deleveraging. That shape has a name. It's a J-curve, and it's the standard signature of capital-intensive infrastructure. We've watched it before. The transcontinental railroads, the late 90s fiber overbuild, the early AWS rollout. Markets consistently price these cycles at the point of maximum pain, when capital intensity peaks and cash conversion troughs, and they consistently mistake the trough for the destination. But I want to be honest about where this argument gets uncomfortable, because there are three real cracks in it. First, upgrading an existing shell is not a rack swap. Going from 40 kilowatt densities to 120 kilowatt liquid-cooled architecture means tearing out the internal power distribution and the cooling loops. That retrofit can start to look nearly as expensive as building light greenfield, which is the substitution problem again. You'd think a building is a building, and then you find out the building was specified for a generation of hardware that no longer exists. Second, the balance sheets aren't the same. A hyperscaler with a fat core business can absorb that transition. A neocloud funded on asset-backed debt cannot. And if a capacity pause slows backlog conversion, you get covenant pressure before you get the J-curve. Third, and this is the one that actually matters, the whole thesis assumes demand plateaus enough to fit inside the footprint you already own. If it doesn't, nobody can afford to turn off the cement mixers, because turning them off means handing someone else the market. So here's the bomb. The risk isn't that free cash flow fails to recover once the building stops. The arithmetic on that is close to undeniable. The risk is that competitive pressure means they never get to stop building at all, and a J-curve that never turns is just a straight line down. That's the question worth holding. Not whether the payoff exists, whether anyone's allowed to collect it.
Humor me. Modern finance would like you to know that it's an extremely sophisticated discipline. We have quantitative models, alternative data, algorithmic execution, machine learning, and computers trading with other computers in fractions of a second. And after all of that, when the market goes up, we call it a bull. When it goes down, a bear. 300 years of financial innovation, and our highest level classification system is still basically the gift shop at a zoo. The bear appears to have come first. There was an old expression about selling the bearskin before catching the bear. By the early 1700s, London traders had adapted that idea to speculators who sold securities they didn't yet own, hoping the price would fall before they had to buy them. Today, we call that short selling. Back then, they were sometimes called bearskin jobbers, which sounds less like a financial professional and more like a man who can get you 6 barrels of gin and a horse with no questions asked. Eventually, those pessimistic traders became bears. The bull seems to have arrived as the natural opposing character. The trader betting prices would rise. And this wasn't some Wall Street marketing campaign invented in the 20th century. Bulls and bears were already part of financial language during one of history's great speculative manias, Britain's South Sea Bubble of 1720. The South Sea Company became the stock everyone needed to own. Prices surged, fortunes appeared, credit expanded. People discovered, once again, the extraordinary investment thesis that something going up is evidence it'll continue going up. Even Alexander Pope got in on the imagery, writing about bulls and bears while London was losing its collective mind over South Sea shares. So by 1720, we already had bulls, bears, leverage, speculation, short sellers, financial influencers. They were called poets then, and people explaining afterward that nobody could possibly have seen the crash coming. Finance has made progress. The usual modern explanation is that the animals also fit physically. A bull attacks upward with its horns. A bear swipes downward with its paws. Down. Very satisfying. Although if we're classifying markets by animal behavior, I think we've stopped far too early. There should be a squirrel market. Calm for long periods, followed by everyone suddenly sprinting in opposite directions because somebody heard a noise. A house cat market. Nothing happens all day. Then at 3:52 in the afternoon, something expensive gets knocked off a shelf. And a golden retriever market where every piece of information is bullish. Inflation falling? Great. Inflation rising? Pricing power. Rates falling? Great. Rates staying high? Strong economy. Earnings missed? Long-term opportunity. Eventually, the golden retriever market is just standing there wagging its tail while the building is being condemned. And then there's the lemming market. Nobody's entirely sure why the asset is rising. But it's rising, and other people are buying it. So naturally, we begin our own very rigorous analysis of whether we should buy it too. Finance has a technical term for this. Momentum, which is one of the industry's great talents. Taking behavior that would concern you in a crowd and giving it a factor model. That may be the real lesson hiding inside bulls and bears. The exchange has changed, the technology changed, the information moves faster. The people didn't receive the same upgrade. A London speculator buying South Sea shares on credit in 1720 would understand a modern bull market almost immediately. He'd just be amazed we managed to put the coffee house inside the phone. And maybe that's why the old animal names survived. Because underneath every model, terminal, and spreadsheet, investing still comes down to the same ancient contest. Someone thinks the price is going higher. Someone thinks it's going lower. And both of them are absolutely certain the other guy is an animal.
There are debates that clear a dinner table, and there are debates that clear a cap table. It's time for the greater debate. This is the second kind, because one side says, look at the revenue growth, the other says, look at who your customer will be taking orders from, and suddenly every portfolio manager in the room discovers an urgent email. A lecture hall, half converted into a stage, two lecterns angled slightly toward each other instead of out at the audience. Between them a screen nobody's bothered to turn on. The crowd is mostly people who manage money for a living, and they've come in with their arms already folded. Tonight's question is the SaaSpocalypse, which sounds like either an investment thesis or a direct-to-streaming film about Salesforce administrators fleeing San Francisco. The proposition is simple. Does agentic AI merely change software, or does it change what software companies are worth? That distinction is the whole evening. Because the easy version of this argument is whether Salesforce and ServiceNow and SAP and Workday and Adobe are about to disappear. They're not. The harder version is whether the economic architecture that made software as a service one of the great business models of the past 20 years survives when the thing using the software is no longer necessarily a person. At the first lectern, Mark Benioff. At the second, Steve Jobs. And let me be precise, because I'm not claiming to know what Jobs would say in 2026. He's standing in for an instinct he demonstrated repeatedly, that when a new computing interface arrives, you shouldn't assume the old layer keeps the economics just because some of its technology survives. Benioff opens with a scoreboard. If this is an apocalypse, he says, somebody forgot to notify the customers. ServiceNow just posted subscription revenue up 24.5% year over year. Current remaining performance obligations up 21.5% in constant currency, and an AI business that crossed $1 billion in annual contract value. SAP's cloud revenue grew 24% in constant currency, current cloud backlog up 26%. Salesforce's last reported quarter showed total remaining performance obligations of nearly $68 billion, up 11%. And Agentforce annual recurring revenue at $1.2 billion, up 205%. There's a murmur, because this is not the chart you expect after somebody attaches an apocalypse suffix. He presses. Customers aren't ripping out their systems of record because a model learned to fill out an expense report. The agent still has to know who the customer is, what they bought, what they're allowed to do, what price they were promised, which regulations apply, and whether the man requesting the wire transfer is actually the CFO. Agents don't eliminate enterprise architecture, he argues. They multiply the number of things that need access to it. Today, you've got 10,000 employees touching Salesforce. Tomorrow, 6,000 employees and 40,000 agents making calls against the same data. Counting seats stops meaning much. Activity on the platform goes up. Jobs waits through all of it. Then he changes the temperature with one line. You're confusing being necessary with capturing the value. Silent. He gives Benioff the infrastructure. Keep the database. Keep the compliance layer. Keep identity. Plumbing survives every architectural revolution. It doesn't mean the plumber owns the penthouse. First audible reaction of the night. His case isn't that software vanishes. It's that software becomes subordinate. For decades, humans navigated applications. We learned Salesforce, Excel, Photoshop, Workday, SAP, and every one of them got its own interface, its own workflow, its own certification track, its own small priesthood of consultants. But if the instruction becomes renegotiate our expiring vendor contracts under these parameters and something moves across procurement, email, ERP, legal documents, and payments to do it, then the application isn't the center of the experience anymore. He looks across the stage. You built software on the assumption that people would operate software. What happens when software operates software? That one rattles the room. Benioff doesn't flinch. He concedes it. Per-seat pricing is genuinely vulnerable. If companies employ fewer people to do the same work, Charging by human headcount eventually collides with arithmetic. And some products really are just an interface wrapped around a database and a workflow. Those companies should be nervous. Then he turns it over. Pricing model isn't business model. You can charge for consumption, transactions, agent actions, outcomes, premium data, some hybrid of all five. The commodity was never the seat. The scarce asset is permission to act on trusted enterprise data. And the more autonomous the agent, he says, the more expensive the mistakes. A human clicking the wrong field is annoying. An agent making the wrong decision 10,000 times before lunch is a governance incident. Audit trails, access controls, data provenance, reliability, suddenly the boring things stop being boring. Jobs smiles, because that's his opening. That's exactly what incumbents say during every platform transition. They explain all the reasons the new thing has to connect to the old thing. And they're usually right. They just draw the wrong conclusion from it. The smartphone still needed telecom networks. Carriers did not end up controlling the smartphone experience. The internet still needed servers and databases. That didn't preserve the strategic position of client-server incumbents. A layer can stay indispensable and become economically minor at the same time. Then the sharpest thing he says all night. Remaining performance obligation is a measure of contracted business. It isn't architectural destiny. It tells you customers are committed to software they bought under yesterday's operating model. It cannot tell you which layer controls the next purchasing decision. 68 billion of Salesforce RPO and 22.9 billion euros of SAP backlog are powerful evidence against immediate collapse. They're much weaker evidence against eventual value migration. You can hear portfolio managers editing spreadsheets in their heads. Benioff comes back with the counterpunch. Fine, then who owns the agent? If frontier models become interchangeable, and enterprises are already running several, the model may not own the customer relationship at all. The agent still needs memory, permissions, business semantics, process context, integrations, trusted data. Model intelligence can commoditize fast. Enterprise context doesn't. And if that's how it breaks, the supposedly obsolete platform becomes the control plane deciding what every agent is permitted to know and do. ServiceNow is chasing exactly that, calling itself an AI control tower. SAP is building its autonomous enterprise strategy around business data and process rather than betting. The model becomes the operating system. Jobs pauses and gives ground. Enterprise computing isn't consumer electronics. Nobody swaps a global ERP over lunch because the new interface has nicer animations. Regulation matters. Data residency matters. Procurement matters. Integration debt is real, and systems of record may outlast the applications sitting on top of them. His whole argument, he admits, depends on agents becoming reliable enough that businesses hand them consequential work. If that's 10 years instead of 3, incumbents have all the time they need. Benioff offers something equally uncomfortable. Incumbency can be anesthesia. You can add AI buttons everywhere, rename the conference after agents, change the pricing vocabulary, and still miss that customers want a fundamentally different way to work. If the agent becomes the interface and Salesforce is one database among many behind it, Salesforce survives beautifully while the rent moves somewhere else. And that's where it stops, because that's where the honest version of this ends. Benioff has the better evidence about the present. Revenue is growing, backlogs are healthy, AI products are already material, and nobody's abandoning these platforms. The apocalypse isn't in the financial statements. Jobs has the better question about the future. When humans stop being the primary operators of software, does the value stay with the applications they use to operate, or move to whatever decides which applications get used at all? But notice, they're not actually arguing about the same thing. Benioff is arguing from what enterprises still require. Jobs is arguing from what technology eventually makes unnecessary. Those aren't the same question, and both answers can be true simultaneously. SaaS can survive the transition and lose economic power. Seat pricing can collapse while transaction volume explodes. A system of record can become more important operationally and less important strategically, which means the winner probably isn't the company with the smartest model or the biggest database. It's whoever owns the moment where intent becomes action. And somewhere between those two lecterns sits several $1 trillion of market capitalization, trying to work out the difference. And that is the greater debate.
Let's invent again. The problem was proving you're a person. Around the turn of the century, the internet developed a pest problem. Software was opening fake email accounts by the thousand, stuffing search results with garbage, and buying up concert tickets before a human could get a finger to the mouse. Yahoo went to a team at Carnegie Mellon with what sounds like a technical request and is actually a philosophical one. How do you prove somebody's human to a machine when the thing you're defending against is a machine built specifically to imitate humans? You can't ask for a password because software has passwords. You can't ask it to be fast because software is faster. You need to find something a person can do that a program simply can't. And then you need that gap to hold. The person who found it was Luis von Ahn. He grew up in Guatemala City, the son of two doctors, and spent a good part of his childhood wandering his mother's family candy factory, trying to work out how each machine turned raw sugar into a wrapped sweet. He wasn't eating the product, he was reverse engineering the equipment. When he was 8, he got a Commodore 64, and that same itch just moved to a glowing screen. By the time he got to Carnegie Mellon for a computer science doctorate, he'd been looking for hidden mechanisms for about 15 years, which turns out to be excellent preparation for a question nobody had a clean answer to. What he and his collaborators built was CAPTCHA, completely automated public Turing test to tell computers and humans apart, which is a name that badly wants to be an acronym. The insight was small and a little mischievous. In 2001, people were still much better than software at reading text that had been warped, stretched, and smeared with noise. Your brain does that effortlessly. It's built to find the letter under the distortion. Software of the era simply couldn't. So the system threw up a mangled string. A person read it in about 2 seconds, and a bot sat there. Yahoo deployed it, and it spread across the web almost overnight because it was cheap, it scaled, and it required no cooperation from anybody. And that's where it should have ended. A clever fix, filed away. Except von Ahn kept doing arithmetic he probably shouldn't have. Millions of people were solving these puzzles every day. Each one burned about 10 seconds of real human attention, and the instant the login went through, that effort simply evaporated. Add it up across the internet, and you're vaporizing something on the order of centuries of human cognition a year for no output at all. So he pointed it at something. That's reCAPTCHA. Instead of generating a random string, the system started serving real scanned words out of old books and newspapers, specifically the words that optical character recognition software had failed to read. You'd get 2 words. One was already known, and that one was the actual test. The second was the one nobody could read, and the system just watched what you typed. When enough independent strangers agreed on it, the archive gained a clean transcription. The same 10 seconds that used to prove you weren't a robot now quietly transcribed a page of history. The New York Times fed in more than a century of its back catalog. Google bought the technology in 2009. By 2018, something like 1 billion people had collectively digitized books and newspapers they had no idea they were reading. Nobody volunteered. Nobody was paid. Nobody was tricked either. They got exactly what they came for, which was through the door. Now here's the unexpected consequence, and it's the one that puts him in this episode. The whole thing rested on a bet that there was one specific job a machine couldn't do. Read a smeared word. And that bet has been quietly losing for years. Software reads distorted text better than you do now. So the test kept mutating. Pick the traffic lights, click the squares with a bus, and eventually no puzzle at all, just an invisible read of how your mouse moved across the page. Every version is the same wager placed on a narrower and narrower patch of ground. Which is the whole episode, really. All week we've been looking at things with no substitute. Copper you can't design around, a material one country controls, a worker who left the labor force and isn't coming back. CAPTCHA was the opposite. It was an entire security architecture built on top of a human advantage that turned out to be temporary, and the people who built it were the first to say so. What outlasted the advantage was the design principle. Von Ahn went on to co-found Duolingo, where roughly 93% of learners never pay a cent, and it works anyway. Same instinct. Take something people are already spending, a spare 7 minutes, 10 seconds at a login, and aim the side effect at something worth having. That's the part worth carrying into Monday. He didn't find a way to get free labor out of people. He found the moment where somebody's small, selfish, immediate action could be pointed at a larger problem without costing them anything extra. Design it that way, and the side effect eventually becomes the main event. That's it for another episode of Wealth and Means, advice dressed up like hard work.
We hope you enjoyed the arc. From copper sitting on a dock in Baltimore to 10 seconds of attention at a login screen, what trades freely and what refuses to. The pattern was simple. Substitution has limits.
Subscribe, rate, and share this episode. It helps more than you think.
We do this for you to help you have a better week, a sharper mind, and maybe even a longer attention span.
And a special thanks to our sponsor, agentweekly.ai.
Till next time, stay curious
Stay kind.
and keep compounding.